There is a quiet, rhythmic movement happening across the United States right now that isn't making the front page headlines of the major networks, but it is being felt in the living rooms of millions of Americans. It's the sound of a mouse clicking sell on a 401k dashboard in the middle of the night. It is the heavy realization that the numbers on a screen, which were supposed to represent decades of security, feel increasingly like a mirage. If you are over 45, you have likely felt that familiar tightening in your chest as you look at the cost of groceries, the rising property taxes on a home you've owned for 20 years, and the strange, volatile swings of a stock market that seems disconnected from the reality of your daily life. You are not alone in this anxiety. We are witnessing a significant migration of capital as middle-class investors begin to panic, or perhaps, more accurately, begin to lose faith in the traditional buy and hold mantra that has been the cornerstone of American retirement planning for 40 years. Before we dive into the structural reasons why this is happening and what it means for your specific future, I would like to invite you to join our community. If you value deep, calm, and data-driven analysis of the forces shaping our financial lives, without the noise of partisan politics, please take a moment to subscribe to the channel. It ensures you won't miss our ongoing explorations into the changing American economy. The panic we are seeing today isn't born of a single event, but rather a slow-motion collision of three distinct economic forces. First, we have the persistent shadow of sticky inflation. While the official Consumer Price Index numbers might show a slight cooling from the peaks of previous years, the compounded effect on the middle class has been devastating. For a worker in their 50s, a 2% increase on top of a 20% cumulative rise in the cost of living isn't a victory. It's a permanent reduction in their future purchasing power. This leads to what economists call lifestyle deflation, where people realize that the million-dollar nest egg they spent decades dreaming of will now only buy what $500,000 bought when they started their careers. Second, we are facing a housing market that has become a gilded cage. Many Americans over 45 are sitting on significant home equity, but find themselves unable to move because the cost of a new mortgage or even a smaller downsized home would eat their retirement savings alive. The third and perhaps most unsettling factor is the fundamental shift in how the stock market functions in 2006. We are no longer in an era of broad-based growth where a rising tide lifts all boats. Instead, we have moved into a K-shaped reality, where a handful of massive technology firms, driven by the frantic promise of artificial intelligence, dictate the direction of the entire market. For someone with a 401k heavily weighted in index funds, this creates a terrifying lack of true diversification. You might think you own 500 companies, but in reality, your retirement is tethered to the quarterly earnings reports of 5 or 6 CEOs. When those specific stocks face a correction, the panic selling we see isn't just about fear. It's a rational, if desperate, attempt to protect what is left before the next cycle of volatility begins. This brings us to a structural revelation that most mainstream financial advisors are hesitant to discuss openly. The 401k system was never designed to be the sole pillar of American retirement. It was intended as a supplement to pensions and Social Security. But as private pensions vanished, the 401k became the primary engine, shifting all the risk from the employer to the individual. Today, that risk is becoming unbearable. Many investors are realizing that the target date funds they were defaulted into are poorly equipped for a high inflation, high volatility environment. These funds often hold long-term bonds that lose value when interest rates remain elevated, leading to the rare and painful scenario where both your stocks and your bonds are losing money at the same time. If this insight resonates with your current experience, consider subscribing to stay informed as we track these shifts in real time. Your support allows us to keep providing this level of independent research. The practical implication of this shift is that the old rules of retirement are being rewritten without a manual. The panic isn't just about selling stocks, it's about a fundamental loss of confidence in the timeline of retirement itself. We are seeing a surge in unretirement, where individuals in their 60s are returning to the workforce not because they want to stay active, but because their 401k withdrawals can no longer cover the rising cost of health insurance and property taxes. The stress of the sandwich generation, those supporting adult children who can't afford homes while simultaneously caring for aging parents, has reached a breaking point. When a 401k holder sees a 5% dip in a single week, they aren't just seeing a number go down, they are seeing months of their freedom evaporate. This is why they sell. They are trying to grab a life vest before the ship leans any further. However, the tragedy of panic selling is that it often locks in the very losses that the investor was trying to avoid. When you exit the market at the bottom, you miss the inevitable, if jagged, recovery. But can we blame them? When the cost of a basic existence has been recalibrated by a decade of monetary expansion and supply chain fragility, the long game feels like a luxury that many can no longer afford. The middle class is being squeezed between a government debt crisis that threatens the future of Social Security and a private market that feels more like a casino than a treasury. As we look toward the remainder of 2026, the quiet anxiety in the American suburbs is likely to intensify. The pressure of the upcoming midterm elections and the uncertainty of global trade policies will only add fuel to the fire. The decision to stay the course or to pivot to cash and tangible assets is the most significant choice many of you will make in your lifetime. It requires a level of emotional discipline that the human brain isn't naturally wired for, especially when the stakes are your dignity in old age. We must move away from the idea that a 401k is a set-it-and-forget-it instrument. It requires active, sober engagement with the reality of our new economy. Thank you for spending your time with me today. If you found this analysis helpful and want to be part of a community that seeks clarity over chaos, please subscribe and turn on notifications. We are committed to navigating these turbulent financial waters together. In the end, the most valuable asset you have isn't the balance in your brokerage account, but your ability to remain calm and informed when everyone else is reacting in fear. The horizon is uncertain, but it is not invisible. We simply have to be willing to look at it for what it truly is, rather than what we wish it to be. Stay safe, stay rational, and take care of your future.